Can stocks carry May's momentum into the summer? Let's ask Chris Toomey. He's Morgan Stanley Managing Director of Private Wealth Management. Welcome back. How would you answer that? We have a lot of momentum, obviously. Does it last?
I think we're probably still range bound. I think the concern we've got is that while I think we've taken the worst case scenario with regards to the Liberation Day, we're in a situation where I think the market's right now probably pricing in the best case scenario, right? I think everyone's talking about the fact that there's probably going to be 10% tariffs across the board, 30% for China. I think that's kind of baked in. If you look at what's happened, earnings expectations down about 5% this year, down about 10% next year. We still don't have any clarity with regards to what this is going to mean going forward. So you don't necessarily have guidance for companies to make decisions as to what they're going to do in regards to this.
Yeah, but you need that? I mean, if I told you, here, let me pick this. If I told you, okay, 10% baseline tariffs, but we're going to have tax relief and we're going to have deregulation, which, Jamie Dimon went down the list today of all the things that you need to fix that the regulators just have too much of a hold on. Oh, and by the way, because now the Fed knows what's going on, you're going to have tax cuts too. And earnings were already better than expected. Where's the negative in that?
So look, I think the earnings were better than expected after coming down.
Yeah, they were way better.
And I think they're also expensive now, right? So we're still at 22. Expectations have come down. So from a pricing standpoint, the market's still expensive. If you look at the Mag 7, they're still now north of 40% or 40 PE, right? So in our minds, the market's not really pricing in some of these risks that we still haven't worked out, right? And so for our mind, until you get some of that clarity, I think we'll be range bound. I think the good news is we've taken the worst case scenario out of this. I think until we resolve some of these trade disputes, until we actually pass through this BBB bill, until we get some real certainty within the bond market, we would still be a little bit cautious with regards to public.
The market's not going to wait until the bill is signed, sealed, and delivered.
Well, I think
doesn't the market anticipate stuff like this? And probably already has to some degree, wouldn't you say?
Well, look, I think that's the point is I think their positioning is probably too positive. In our minds, we still think if you look at GDP growth next year or this coming year, it's coming down. I think prices are going to go up. I think the Fed, as we heard yesterday, is still on hold. So what we've done is we've taken our earnings expectations down. We've modeled in the fact that the Fed is going to continue to be dovish this year. And our expectation is maybe second half, once we get through some of these things during the summer, we start looking into 2026. And to your point, some of these other things that we're seeing start becoming more prevalent, right? So we're in a situation where we start to see deregulation coming in, which should be beneficial for financials, which we're starting to add to. We also think once the bill is passed, we'll get some real confirmation that we're going to be investing into the U.S., that'll spur economic growth. So we're adding to some cyclicals a little bit in industrials and in energy, but we still think the market's probably expensive right now, and we don't want you to get too aggressive right now from a positioning standpoint.
Part of your answer just now, you said prices are going to go up. What prices? What are you talking about? Like consumer prices?
Well, prices with regards to stocks or prices with regards?
I don't know. You answered the question, and you were listing all the things that were going to happen. And one of the things you said were prices were going to go up. So you talk about companies raising their prices?
So there is going to be inflation, right? So you've got demand coming down, you've got prices going up because, their tariffs are going to go from 3% to 10%. So that needs to be built into earnings, right? So whether or not companies are going to feel that pain, whether corporations are going to feel that pain, whether consumers or governments are going to feel it, it's going to draw growth down, right? The good news is
deflationary, isn't it?
No, that's inflationary. So prices are going down. Demand is coming down.
Demand comes down. It's deflationary.
It's stagflationary, right? So prices are going to stay high or go higher, right? Because costs are going higher. You've got a situation where the global supply chain, where a lot of it is on demand with regards to coming out of China, that's at 30%. We still haven't resolved that, right? And so you can see that with companies that have direct connectivity to China actually not doing as well. You can see that in the Mag 7, and you can see that in the rest of the overall S&P 500. So in our minds, that's going to be a stagflation issue. If we do see GDP growth coming down, that might give us the opportunity for the Fed to step in next year and start cutting rates, and that we think would be
next year.
Yes.
So you don't think they're going to do anything this year?
No, we don't think they move on the data until looking at something in September or October, and then that would probably foresee something happening in next year.